We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver and Vince Lanci. Michael Oliver is from Momentum Structural Analysis, and Vince Lanci is a professor of MBA Finance and publisher of the Goldfix Substack. Thanks for joining me today, gentlemen.
Great to be here.
Thanks for having us.
So I'd like to start by talking today about all of the metals, all of the general equity indexes, commodities, and also get kind of both of your takes on going to the election and what that ends up meaning, basically what the effect of the chaos and uncertainty means for the markets as we go through today. But, I thought we could start, Michael, maybe by jumping in and talking about the Nasdaq. And really, I think this highlights the importance of really looking at momentum instead of just price, right?
Sure. It's definitely the leader index. The S&P since the 2009 bear low has gone up 7 to 8 fold. Enormous, okay, historically speaking. But Nasdaq gone up like 17 to 18 fold in price since the 2009 bear low. And there's no comparison in U.S. stock market history to the age of the bull, and two, the dimension, the percentage gain. Mm-hmm. And if you look at it, an M2 chart or a Fed funds rate chart, you sort of understand what filled the tank. Okay, where'd all that money come from? Well, we know where it came from, and it went into the stock market. It doesn't always, but it did then, because frankly, at 2009 low, the market was washed out. So anyway, there's two realities here. One is that we've gone up and taken out the 2021 high on Nasdaq. It was like in November of 2021, collapsed into 2022. We put out a major sell signal in January of 2022, a couple of months off the high. And sure enough, there was a sharp drop, not a bear market quality, but 30% type thing. Far more than the S&P dropped. It dropped 20-something%. And then we rebounded. It took us 2 years plus to get back to and through that late 2021 price high. So it took a long time. When you look at the price chart and say, whoa, boy, the game's on again, could be. We look at momentum of price on different time scales. And what you've got here is a very long-term momentum chart, annual momentum, where we measure each month's close. Where is it in relationship to the 3-year average? And of course, that 3-year average shifts every year, adjusts a bit, upward, obviously. It's overlaid on the price chart. The zero line itself, in other words, the 3-year average itself, isn't necessarily technically that important. Sometimes an average is, sometimes it's not. It's the structure that's built by momentum. You look at that price chart, you try to draw a trend line that connects multiple lows, and you can't do it. You could find 2 or 3 lows, and then it curves upward. So you'd have to draw an arc. Mm-hmm. So it's very subjective in terms of drawing a trend line. But on momentum, since the 2009 low, you have a parallel channel that's defined with 5 peaks that line up perfectly, parallel to one that connects 2009 low, 2020 COVID low, and a minor rebound that occurred in early 2022, just before you broke it. So it's like a 8-point trend line, okay? Parallel, perfectly defined, and was very happy with the price action all the way up through early 2022, and it blew that structure out. Momentum said, uh-oh, I'm broken. Price apparently thinks it's not, and we think it is, because this is what momentum looks like. If that bottom chart were a price chart, would you be bullish? Okay, that's the question to ask yourself. Mm-hmm. Usually momentum will lead price. And in this case, it's saying, I'm broken. I'm having a rally up to resistance. And if I start to roll over from these current levels, even though price is in the new high, you start to roll over much on those momentum readings, you're going to get the next leg down. And that's what we bet on. Anyway, this is the leader index, and therefore it's likely to go down more than the others as well.
Well, I find it an interesting, counterpoint here to really look at this data in a different way to give us another confirming or disconfirming signal, right? And we're going to look at a couple more charts that are kind of really building that case. Anything to add here, Vince?
Yes, actually, and not in that vein, but I have a feeling it probably complements it. One of the things that I've noticed about the stock market, and I think everyone sees the name Nvidia. Nvidia is the leader of the stock market, and when you're in a bull market, not necessarily early or late, but when you're in a bull market, you want to see the breadth spread. You want to see leadership change hands. And about when we came off of those lows after the 22 sell-off, I was thinking, right, and I was looking at, and other analysts were as well, that, okay, we'd have the leadership be whoever it was, Apple, and then the breadth kind of just opens up, and other companies, they're looking for the Reuters 1000 to the Russell 1000 to lead, and they never did. It just got narrower and narrower, which I don't know if breadth and momentum are complementary, but at least from a different point of view, Nvidia is the whole market. It's the head of the snake. And, if Nvidia drops, what are you going to buy? It's like we're replacing bubbles with new bubbles. And I don't mean to be a doom and gloomer, but there's no breadth to this market. Even Michael Hartnett was saying that. He's like, this market is long in the tooth, I think was the phrase he said. And because no one's changing hands, I think if you kill one, you kill them all. And right now I'm seeing in the indices that I watch, the AI bubble, if you want to call it that, is now spreading. People are taking their profits in AI stocks and they're buying AI infrastructure stocks on them. So when we hear the news eventually that right now AI is a great technology that's really just substituting for customer service, then the AI demand, it's the customer service, and the AI leadership drops, and then the infrastructure stocks would drop as well, and then I think you would have nowhere to run because Apple's not a darling anymore. So, I would say yes. I haven't been short this market, but I don't know where to sell it, and I guess that's why I'm listening here.
Yeah, it's always interesting to try to understand, as you're saying, Vince, the breadth or that distribution of who's actually leading the market. And, I don't think at any other time in history, or, there are other catastrophic, let's say, times in history where we have had such a concentration in such a small amount of names in the stock market that are leading, right?
Yeah. A question for Michael, actually, if you don't mind.
Of course.
Do breadth and momentum have any relationship that you've seen, any correlation worth looking at?
It's not measurable by that's one problem with it. Yeah,
right.
It's sort of measurable in the sense that it's bloody obvious.
Right.
It was 5 or 6 stocks, now we're down to a couple, and that's not good. Right. And the truth of AI, let's say, is real. Okay, let's say it's really real. What they say about it, what they claim it will change the world. Let's assume that's correct, because it was correct when the .com top. Okay, the internet's going to change the world. Boy, the people advocating that and professing that were dead right. It changed the world more than they even anticipated. And yet the Nasdaq 100 dropped 82% when the .com bubble broke. Okay, so it's a matter of too far, too fast, overpriced, uncertain territory. Yeah, it's not invalid that it goes down. It's just that it got too far ahead of itself. Inhale and exhale. And I think what you pointed out there, the narrowness is conspicuous. Now, how you time that, because it's been narrow for a year now, but it was 5 or 6, 7. Now we're down to a couple. So I don't know, maybe it'll be 1.
Well, it was the Magnificent 7. Now I think it's the final 4.
Yeah, something like that. Yeah. And we watch Apple and Microsoft, and they're not doing what Nvidia's doing. They're not going vertical. They're humping around at highs, but they're not dynamic anymore. And frankly, I won't tell you I won't show you the chart of the momentum, but Apple and Microsoft, that last low you just made in both stocks, look at your charts of Apple and Microsoft, the last low we made in April, you better not take that out, because when you do, you're going to blow annual momentum off the page and you'll get a very sharp down. So watch those two, because they're still leaders, even though they're not beating their chest right now. They're definitely weighty leaders. And I think you can probably close your eyes to Nvidia even and just watch Apple and Microsoft, because if they broke those lows of April, the whole market's going.
I like how you put that, Vince, the final four. That's, I think, a good way to put it.
The last one.
So, one of the other things I wanted to discuss with you guys is this importance of copper right now. We have seen it really go up quite a bit, kind of blow through these other all-time highs. But how do you see, let's say, the signaling for the world in terms of copper's importance as a commodity signal or the barometer of health for the world economy?
Well, I won't speak fundamentally, but we all know it's everywhere in terms of, industrial uses. And we also know, we've been told for a couple of years, of course, that's timing is not good, but fundamentally, the supply side analysts of that market say, hey, supply is going to be very tight. It's very constricted around the world. And so, it's going to be a problem down the road. Well, it's starting to show itself in price now. It's interesting, too, what copper's done. It made a high in 2011 at $4.62. That's when gold peaked at $1,920. Okay, both dropped. Then in 2020, gold went up and made a new high. 2 years later, copper went up and made a new high also, taking out the 2011 high. Copper got to $5.02. Okay, so marginally above the 2011 high, just like gold, $100 or so above the 2011 high. Then they both pulled back. And now in unison, gold's gone up and made a new high. And copper's also made a new high. This is the copper miners charts here. And they're echoing what copper's doing. You can see that price has blown through a ceiling of distribution, and momentum is broken out above a nice basing pattern. So then the copper miners are agreeing with what copper's done. So it's as far as we're concerned, it's the entire Bloomberg is headed up. It's done similar action to what you see on that momentum chart below. And it's not just copper, but copper happens to be in one of the leaders this time around. Last time around, in 2020, 2021, it was primarily energy. This time, I think it's going to be food and metals.
Well, it's interesting as you mentioned energy as well, because we have natural gas here as well, and it's just coming off of its lows. When we think about, again, the importance of natural gas as well, is this, again, a different way to be able to understand these charts versus just looking at price and averages?
Yeah, well, obviously the price is free. Okay, when you drop down under $2, they're giving it away. Okay, it's so if you like buying low, just throw a dart that you're not going to zero. Okay, and sure enough, it's popped back up. They had lows around $2 back in 2023. You can see it slightly to the left there, and we blew through that early this year and got down to like $1.60. Okay. Then you couldn't get back over to. You tried for several months to get back over to, couldn't do it. They were selling at the old lows. We burst through that about 4 or 5 weeks ago in price. Now, when you look at the price chart, though, it's kind of hard to determine, is there a trend line? Do you have to get up above that $3.60 high we made in late 2023, that minor high, before you can say, okay, finally, it's positive. Okay. When you look at momentum, this is why we emphasize structure, not just oscillating like an RSI or MACD, the very popular loop type things. We like to see trend structure. Well, when you look at a momentum chart, what we're measuring here is, what does each week look like relative to the 40-week average? Why 40-week? Same as the 3/4 average. It's almost the same as a 200-day average in terms of its duration. Okay. But anyway, so when you oscillate price versus that average, you end up with a structure that smacks you in the face. A trend line, 1, 2, 3, 4-point trend line. you got nearer to week or so. This is a week or so old here, but you get back over that trend line, and it's saying, okay, that was it. We're entering a bull market again for natural gas. Mm-hmm. Now, what dimensions it might be, I'm not sure, but it's definitely got the technicals to justify claiming it's no longer bear, it's back to bull mode. And it won't take much to break out over that structure.
Vince, anything to add there on the copper or natural gas conversation?
Sure. It's what Michael's saying about you have to basically create a derivative, because natural gas is really difficult to monitor or model, I should say, over the long frame and or even over the intermediate frame, because the market is essentially a sine curve. It's weather, it's seasonal demand. Now that's changing because of LNG, but not enough. That's the first problem. So you're trading weather if you're trading natural gas historically. Now that's not as relevant as it used to be, because we're exporting a lot more via LNG to Europe, after we rescued them, say, for example, after the whole, we dug the ditches that we're pulling people out of, but that's what's going on there. One thing that people like myself who trade these, we used to look at them in strips. So there's two shoulder seasons, but just to be a little bit geeky here, it's summer and winter, right? So to simplify it, it's Novi through March and April through Oct. And what we would do is we would look at those for our moving averages. We didn't trade technically, but we would look at them for options modeling. We would take the average price of the strip and compare it to the next year's winter. So winter to winter to winter. So we'd actually trade them like multiple commodities. Now, what Michael's saying to actually make some sense out of it makes a lot of sense when you create a structure out of seemingly disparate data, and he's done a nice job of that. The other thing about natural gas is, and this is something that's upside down in terms of what's going on in the world. In the world, oil is becoming less global and more regional because of the whole trade embargoes and the sanctions and the whole mercantile trade protection type of thing. And natural gas is a regional commodity. Okay, so natural gas in Henry Hub is not going to go up as much as natural gas in Colorado Rockies. But while the rest of the world is fragmenting from globalization, natural gas is coming together more globally. And that's because of the LNG, because of the exports that are going to Europe. And the reason that's important going forward is, as you see more cross-ocean fungibility, you will see more spot-driven moves filter into the futures, and you'll have a more sustainable, less volatile bull. That's my opinion, but that's some observations from the fundamental side.
Yeah, it's interesting to consider all of these markets from this more macro perspective and understand the changes that are happening within the this trend of deglobalization. But in this case, as you're explaining, Vince, natural gas and LNG is becoming more global.
Right.
Guys, I'd like to move a little bit to the metals here. Michael, in your last report, you did some analysis on the last run up in silver. And I think this is a perfect example of why momentum serves a vital role in really getting a perspective on bull runs like this and how it can be instructive on when to enter and, more importantly, when not to exit an investment like this. Mm-hmm. So this is the chart of, August 2010 to 2011. And in it, you've circled all of these drawdowns. Yeah,
this was the phase. This was also true in 1979, in the last several quarters of the 79 to 80 bull peak in silver, where it got to 50 also. Then it went from like $10 to 50 in 6 months. In this case, you went from like what you're dealing with $17 to 50, and it took you 8 months or so. Okay, it's the acceleration phase of an ongoing prior bull trend. In other words, you go up incrementally for years, it's arm wrestling all the way, bores the heck out of people, scares them all the time, and then finally you just lift off. And you pave the road with the bears. Okay. Anyway, the problem with the acceleration phase is, and I think we've now entered one in the current bull market in gold and silver, is that people learn from the prior action of that market, the up-down action, like from 2020 to 2023 on silver and gold, where every rally you could sell it, it'd go back down, you'd rally again, you could sell. It taught people a false lesson about the nature of their market. So when the market finally busts loose, and by our metrics, it has busted loose, and you're now seeing it in price. We got our major acceleration phase signal for silver in the upper $25 zone several months ago. Well, now it's trading 32. Okay. It started. And I suspect it's going to last several quarters at most before you get some action similar to this, if not far more exaggerated than what we see here. But during that time, it still hits you with sell-offs. And we've circled, these are dailies now. You can see there's multiple sell-offs, and we defined below this chart the percentage drop. And some of them are 5, 6, 7, 8, 9, 10% drops in several days. So they spook you naturally. Because you think, oh, it's just like in 2022, 2023. No, it's not. We're in a different type of market now. Finally, there was one actual correction on that chart above that you could call a correction. If you'll scroll back up there, that's the big ellipse in the middle there. And that was in January of 2011. Silver reached 32 and dropped back to 26. And it spent like a month. So it was time consuming and a bigger percent drop than the others. That's really the only quote correction that you had in this entire acceleration phase. And so, and there was a similar situation in 1979. Also, there was 1 month drawdown in that 6 to 7 months explosion where you had a bad month. Everybody thought that's the top. Okay. It wasn't. So we fully expect sometime probably in the next couple of months that silver could get to a level that signals a start of a correction. But again, from an investment point of view, even that sort of correction is something to ignore. Now, if you're in call options that expire, 3 months hence, then you got a problem. You need to be aware of that kind of correction. Or if you're in a highly leveraged position. But if you're in an investment grade, non-leveraged position, like you own gold, silver miners, you own silver outright, gold outright, you need to ignore even the correction phase. Because it will tease you. You'll think that was the top, and no, it wasn't. I strongly suspect silver's going to leave the page. In other words, we have 2 old highs. Remember, we mentioned copper took out the high of 2011, took out the high of 2022 this year. Gold, same thing. If silver did the same thing, it'd be above $50 right now. Okay, so think about it now. Is silver a dog, or is it just been overlooked? And the metrics of silver right now, not only its own net trend metrics and its momentum, look dynamic. They've entered a dynamic phase. But when we measure silver versus gold, the spread chart, we've had a major breakout. It was the last 2-3 years, silver gained a lot in that 2020 move, a lot more than gold. And then it's in a zigzag type pattern. Here you go, right there. That's it. You can see since early 2021, the spread was up to 1.5%, meaning the price of silver, 1 ounce of silver was worth 1.5% the price of gold. Okay. We plot each month, and you can see we've been in a downward zigzag. And even this chart is not quite up to date. It's a little higher than it shows there. But you can see a month or so ago, we blew out this 1, 2, 3, like a 5-point downtrend line. So the spread says, I'm awake, I'm back, okay? And that's a signal. Similar signal occurred in the 1979 blow-off phase. And I suspect it's got a lot more percent gain than you'll see in gold will come in silver. So it's time to shift emphasis back to that.
So, Michael, when we're looking at these different time frames and, you're comparing momentum, for example, to like a 50-day average. At other times you use 3-day and 3-week averages. does it start with shorter timeframes and you're building a more solid case for an investment as you move through these larger averages?
Well, when we assess that we're in the acceleration phase in the monetary metals, for example, it's based on long-term metrics, quarterly momentum, annual momentum, like measuring price versus a 3-year average, et cetera. And we had clear basing structures. You could not see it on a price chart. You had it in gold, you had it in silver, you had it in gold miners, where after that 2020 surge, the momentum readings came back down, as did price, and price went into sort of an irregular zigzag. But those momentum charts went into a basing pattern, literally horizontal, like a crew cut. And you blew through that in April and May. Okay, big time on GDX, for example, silver and gold, almost simultaneously. So they all said, I'm back, I'm reborn, okay? I've had my gestation period. And so it's not the short-term stuff we're looking at. Short-term metrics sometimes are helpful if you're interested in a short-term trade. Sometimes the short-term will fit with the long-term. But remember, the short-term stuff zigzags like a rapid heartbeat compared to the long-term, which is more prolonged heartbeats in and outs. So if you're interested in what we're seeing now, you've got to focus on the long-term metrics having broken out and tend to ignore, to some extent, the short-term metrics, which unfortunately a lot of silver traders are focused on the short-term. And therefore, every time it gets, quote, overbought, they, I've got to sell it, it's going to collapse. And it might have a bad day, and it turns around and makes a new high. So, yeah, long-term is important at this point.
Vince, as we're discussing this run in silver, how do you try to get perspective when understanding where it's headed and what it's doing day to day? I did an interview with a silver analyst last week, David Jensen, or a metals analyst, David Jensen, that, he's looking at what's happening in silver and kind of going through understanding how that ends up affecting the banks and the positions that they have as part of that. So how do you try to get perspective in this market as well?
Well, I mean, that's a very broad question, and you don't want me to go down the rabbit holes there, I think, too much. But there are several disciplines that speaking about silver specifically. Okay, right now I can give you what I'm looking at right now by examples. And actually, if you put Michael's chart up, the gold silver ratio, it might be a helpful visual tool. When gold and silver are in the old market, he was talking about behavioral conditioning, and how people take their profits short because they've been conditioned, and how when you have a big 4% move in silver lower, it makes you say, oh, here we go again, and it breaks the market, at least temporarily, and how it conditions us. I'm going to share a conditioning that I have and give you an idea how I fought it without, technicals confirm what I'm thinking. When the gold silver ratio on Michael's chart breaks up, or most people look at it inverse, when gold breaks down as a ratio, historically for me, that's the sign of, in the intermediate term, it's at least in the short term, it's a top. And I'm not talking about his trend line. I'm talking about when it just breaks a significant level and silver starts to catch up to gold. And here's the reason for that. On day-to-day trading, I'm not referring to investing, I'm talking about trading, right? On day-to-day trading, the market's dominated by two types of investors, right? Or investors is the wrong word, but CTAs and macro discretionary. And CTAs, or commodity trading advisors, are basically fancy aggregated retail. And retail traces momentum. So what'll typically happen is your Paul Tudor Jones types will come in and they'll buy gold. And then gold will move. And then over a period of time, then silver will, everyone's saying, what's going on with silver? What's going on with silver? And then silver catches up and then it gets done. So it's kind of like a late to the party overperformer. And there's a reason for that. And the reason is people that have money allocated, you'll see this frequently during buy season when people start putting their money in for end of the year allocations. They'll say, I'm going to put 5% of my portfolio, my RIAs will put 5% of their portfolio into gold or precious metals. And gold will start to run. And then the guys that are late to the party, the smaller funds, the CTAs, will say, all right, well, silver's undervalued, I'll buy that. And that will be kind of like the last puff on the cigar before it dies. Now, in the normal market, and was the normal market, we're not in that market anymore. Because, in my opinion, the market has been sat on and cooked lower for so long, not just directly from price fixing, but from market structure and the inability to trade it in truly free market. What we've done since the 90s, what the government has done successfully, is they've shaken out the macro discretionary, the big guys, except for maybe Paul and a couple other guys. And so the big guys don't play anymore. And so my concept of, when silver rally is near the end, that has been correct, because it's only CTAs trying to get another puff out of the last, inch of that cigar. Well, in March of this year, and this is going to tie in with why I look at this time and I say, you know what, this is real. And I'll tell you why. In March of this year, before March, I identified a sovereign wealth fund buying gold. No one's playing in silver. In fact, most of the bullion banks are suppressing silver to keep gold down so they could get more bullion back. So they're putting on these gold-silver spreads. But on March 1st, gold starts to ramp, and it starts to touch its 2% up day, which is something you rarely see. And between March and April, it wasn't the CTAs getting in, it was the macro discretionary guys. And the macro discretionary guys like to get in at the end of a month when there's a new high, and they just kept getting in. And then the end of the month came again, and I said, and they were all in the money significantly by $100. And I said, oh, well, silver's next. And sure enough, a month later, not the next day, silver started to rally. Now, my first inclination was, here we go. It's the dumb money buying. Dumb is a euphemism, right? It's the late money buying, shopping for value, and that's the top. But I didn't see gold sell off. The behavior, my short-term momentum indicator said to me every dip should be bought, not sold. And before you know it, I start to see institutional money into silver. And I say, the macro discretionary guys have made, you can't stop them out $10 lower now. They've made so much money that they're saying, you know what, I think I'll buy a little silver now. And this breakout above, using his trend line as it is a good line. I mean, I actually had a line like that as part of a channel going back, Michael, and I used to trade it like that. When it got below a certain level, I would take my profits in silver. For me, I'm upside down to you. Gets below 76, I take my profits. Gets above 92, I would literally go in and buy silver and sell gold, because I knew that a bullion bank was trading that spread that way. Well, guess what? They're not trading it that way anymore. They're short both, and they can't cook one to get the other back. So there are many ways to answer your question, Tom, but I would just say that when I see something in the marketplace, in the market structure, or the flows that tell me something, that's macro, right? I already have a secular opinion that it's going up because of mercantilism. It's going up because of a return to hard money. We'll just put it that way. It's going up because of return to hard money and a world that's deleveraging. That makes me buy dips as opposed to sell dips, right? And then the macro is, well, look at this. Behaviorally, I better stop using the gold-silver ratio as a reason to get out of silver. I should be using it as a ratio to get a reason to get into silver. And Michael's analysis confirms that, in the sense that he's comparing gold-silver now versus momentum indicators, and then going back in 79 versus momentum indicators and 2011 as well. So, I'm on board with this holistically.
And when you look at silver spread versus gold, I only show from 2020 here onward. Silver went from 0.9% up to 1.5+%. That's like buying a stock at 90 and it goes to 150. Doesn't 8 months. Okay, that's literally, that is what it means. But if you go back in history, 50 years, and pick out the highest month each year of the silver gold ratios, expressed this way as a percent. You'll find that 20 of the 50 years, silver reached 2% of the price of gold. There's almost routine. It wasn't a rarity. It reached 2.5%, 3%. One time it reached 6.5%. Forget that one. It was an exception, let's say. But reaching 2% is routine. Well,
Right.
if gold stopped right here and silver went to 2%, you do the math, okay? But let's assume gold is going to have a major surge here over the next 6 to 9 months, like it did in 79, like it did in 2010, 11, okay? Huge dimension move. Well, gold in the past has had a couple bull markets that each were at least 8-fold gains, measured from a prior bear market low to the bull market peak. It might have taken 6, 7, 8, 10 years. They weren't all the same duration, but multiple years. But you had an 8-fold move. Well, we started from 1,050, December 2015. That was the bear low that preceded this bull. 8-fold's $8,000. It sounds like a lunatic statement, right? Okay, well, it's gold doing what it's done a couple times before, except this time we have macro tectonic plates that are clashing and are going to create all kinds of problems globally, domestically, and so forth. So gold might do the routine again. Well, what's 2% of 8,000? Okay. Now, I'm not projecting that's where it must go, but I'm saying it's not abnormal. And so once
Are we not allowed to say 1,600?
well, other people are talking 20,000 plus, and I can't deny these things because I know what's going on
160,
internal to these markets. Yeah. But it's not going to take 2-3 years. I think this is the kind of event that, we'll look at the surge in 2020 even, which was it was brief, 6, 7, 8 months. But silver went from upper teens in price to $30. A huge percent gain. Vastly beat gold and did it in a matter of a couple quarters. In 79, it did it. 2010, 11, it did it. Same type of thing. We're in that same phase now, except it could be even more dramatic. And it's hard to put a number on where might it go, except to look back and say, what has it done before? And the spread has been at 2% multiple times. 2% is a massive move when you go from the breakout here just above 1.2. That's a huge percent gain. It's like buying a stock at 120 goes to 200. Okay. Anyway, we're sitting on major dynamics here, and it's hard to put an estimate as to where might it ultimately go, except to say it's likely to be unleashed in a dramatic way.
I'd like to add something geopolitical to what Michael just said there. Tom? Okay. Over the last 2 years, we've been hearing nothing except central banks are buying gold. Store of value, replacement for U.S. Treasuries, hedge for the dollar, et cetera. And all those things are true. What we haven't been hearing about, and this is why silver had lagged, right, for the last 2 years, is central banks are the buyers underpinning the gold market, but they're not the buyers underpinning silver. And that is one of the reasons that the bullion banks were comfortable going like this. Well, if I need to buy gold, I'll just sell some silver and I'll get my tactical buys off. Well, what I think is happening now, and if it's not, I believe it started already, but if it hasn't started already, you can see it in unofficial capacity. Whatever's going on with the BRICS, this is a geopolitical comment, they're going to use gold as a store of value to secure international trade. Now, in August of last year, all the BRICS members were given homework. And that homework was, this is going to come right back to silver. That homework was, we've all agreed on gold. It's your job to submit what else you want to be a store of value for secure collateral. And everyone's going to come back with their bonds and they'll be rejected. Maybe China's won't be. But since then, India's been buying tons and tons of silver. Now, I believe that where central banks do not buy silver, sovereign wealth funds buy silver. And so I'm offering you a catalyst. You're not going to hear about it until it's too late, which is how it works with silver. But I believe that sovereign wealth funds I know sovereign wealth funds are buying gold. I believe that they're buying silver. And if you look at the offtake coming out of the BRICS for silver, silver is being viewed as a store of value. Now, the reason this is an even more important catalyst is because the higher in price silver goes, the more of a store of value it becomes, and the less affordable it becomes as a industrial metal. So copper becomes silver, silver becomes gold, and gold becomes, in notional terms, gold becomes unattainable. But I think that the 2% number, I don't really have anything mathematically based to say this, but I think 2% is very conservative. I really think that something's going to happen in a big way. If I'm a Latin American country and I don't have a lot of gold, but I'm going to be in the BRICS, right? But I need to have collateral. Well, you're going to start to see gold and silver trade closer to their natural. I'm not predicting 15-1, but they're going to start trading closer to their natural occurrence. Because if you're using gold as collateral and gold occurs X in the earth and you're buying oil with it and you're saying, well, we can use silver as a substitute to gold, you're going with a soft bimetallism. And silver is going to become money in that respect again. Not something I'd wish for. It could ruin economies, but I think 2% might really be conservative. There's a catalyst out there to make that happen overnight.
Why do you think ruin economies, Vince?
Well, when I was a beginning trader in options, one of my mentors was the head of Goldman Sachs Commodity Index, and we were talking about. I would call him from the floor, right? So I was an options geek, and he was the head of GSCI. So I would call him from the floor, and I'd say, "Hey, gold. Hey, gold's up. Should I buy silver?" Right? Or he'd give me a lesson. He'd say, "Vince, Japan bought some gold last night. Here's why." And I'd say, "Great, I'm going to go buy some silver." He'd say, "No, don't be stupid." I'm like, "Why?" And he'd say, "Well," I say, "Well, if you can't corner the gold market, why not corner the silver market?" He goes, "That could happen." But to bring right to the point, all the gold on earth that exists and is obtainable at a price. And I'm saying that it's not used, it's not consumed and hard to retrieve in industry. Silver, on the other hand, even though it's not destroyed, has a cost of recapturing it. So if you were to base your money off of silver and not gold, this is about futures curves. You can have gold be money because it will never backwardate. The price of gold is the same gold in the future. It's not used industrially. But silver can have legitimate, real, backwardated short squeezes. You can't have your money be backwardated. You just can't do it. That's a bond rule. You can't do that. If money were to be backwardated, if silver were money or to be backwardated, then the futures market would not reflect the real demand for the money, and it would all the silver would flow out of one country and into another country, which is kind of what happened to China in the 1800s when England went off the silver standard and onto the gold standard. Anyway, the point is silver is too industrially important, and because of that, it's hard to retrieve when it's used, and there's a cost involved in it, and it's almost like it's consumed. Like you can't make money out of soybeans. You follow me? You can't, because you need it when you need it. That type of thing.
It's, it kind of comes back to part of your comments about the BRICS nations and what they're submitting for collateral comes back to this saying that you give your readers all the time, which is Bretton Woods 3 is a process, right?
Right.
So in that context, Michael, when Vince says Bretton Woods 3 is a process, is this part of how you see really gold entering a more dramatic phase of this bull market?
Well, I think we've had decades of non-backed currencies in the major countries, and it's caused problems. It's caused a constant boom-bust cycle. And it's not just Austrian School of Economics that sees this, but others do as well. That, you can look at an M2 chart or a Fed funds rate chart, and boy, it precedes the booms, and then once the bust occurs, inevitably in the stock market, they come back in and they flood it again. So there's this constant in and out, monetarily speaking. There's no controls on it because it's not backed by gold anymore. Nixon took care of that, the other half. Instead of domestically, it's foreign, not backed by gold either. So we've entered that phase. So it's been, 50 years now of that totally unbacked currency. And it's free to do what it wants to, meaning destroy people's wealth constantly, ongoing. I mean, the money supply doubles every decade. Okay. So that means, if you bought a stock for $10 and 10 years later it's 20, you're not making any money, even though you think you are. That's why a loaf of bread when I was a kid was like 20 cents, and now it's $3.80. We have a wheat shortage? No, the money's degrading constantly. But there's a point at which you can't continue to do that. And I think we're at that point of acceleration now in terms of the deterioration and the perception by many of the consequences of that. Even the average guy on the street who may not understand this at all knows something's wrong. It's chronic. It's not you can't blame the war, Ukraine-Russia war, for the price of wheat now. The wheat topped when the war began. Oil topped when that war began. So that doesn't explain it. That doesn't rationalize it away. And I think we're entering a crisis, therefore, a monetary type crisis, where enough smart heads here and there are saying, hey, we've had enough of this boom bust stuff, this print money stuff. We need something else. And lo and behold, it's coming from, quote, communist China, if that phrase is applicable, which is almost a Monty Python type event. Is it really happening from that side of the world? Yes. And I think they're doing the right thing. And that's going to help them versus us. Mm-hmm. And it looks like the U.S. is going to be the last to respond to this crisis. I've said in some interviews over the last year, I bet in 5 years there's no Federal Reserve. Well, why? Because enough intellectuals here and elsewhere will say, it's not been working, especially when we go into the next bubble break, which I think we're about to enter. I think you'll see a lot of the evidence of that in the next quarter, in July, August, September, well before the election. I think you'll see the stock market start to go. And when it goes, the data points will go. And that's when everybody will start pulling their hair out, realizing the Fed, has done it again. They create a boom, they create the bust. This is ridiculous. And you'll have enough intellectuals. I think some Republican entered, of course, it's not going to pass, to abolish the Fed.
Mm-hmm. That was just recent.
Yeah, just recently. No, it's not going to pass now. But you give it another year or so, or you crash the stock market one more time from the levels with the biggest bubble we've seen in history. And the consequences thereof to the man in the street, there's going to be some big changes. And I think one of them is going to be a flight away from fiat currencies, and now being led over there by the BRICS nations. But it wouldn't surprise me that some German intellectuals say, hey, I'm tired of the euro. Remember what happened in the Weimar Republic. There's enough intellectuals around the world in pockets that will ascend and challenge the prevailing so-called wisdom. And I think gold knows that. I think that's what it's doing. It's already pricing that in, the end of fiats. And God knows where it's going, because there'll be a lot of tectonic plates out there that will be bumping into each other, adding to the fuel for gold. And also panicking the central banks, which what does that mean? That means that the monetary flow is going to increase again. Gold knows that. That's why it's doing what it's doing. It's going to be an interesting year.
Michael, is gold, you wrote in one of your recent reports that gold is not responding to these fundamental factors, but anticipating them. Yeah. And how do you think it does that?
It's been around 3,000 years. Okay. So, UST bond's been around, I don't know how long, a century or so, and the Fed's been around a century. These are the little dots on the history page. Gold's been around. It tends to, plus it's global, and it's, I think, less emotional than stock markets are. And it anticipates what the central bank is likely to do, and it knows ongoing what the central banks always do. That is print. They're there for a primary purpose of supporting the government bond markets. Ultimately, that's what they have to protect. And right now, if you look at the bond markets, look at muni bonds, look at high yield corporate debt, and look at T-bonds. T-bonds are puking compared to those other markets. They're not, especially private debt. You think, well, in 2008 and 2009, it was primarily private collapses. This time around, it's the U.S. T-bond market is the weakest out there. And even Yellen said she's concerned about the, quote, illiquidity in the long-term debt market, the government debt market. I'm sure they're concerned behind the scenes, and they can't talk about it because that would indicate they're panicked about it. But that's a variable that they're watching. And right now, what are bonds doing? They're again pressing to try to go down and take out that October low of last year. Whether they do or don't, I'm not sure. But that is definitely a choking influence on things like the stock market. And I think there's a point at which T-bonds will price themselves into a situation where they could go up, meaning yields drop. There's technicals for that. We've noted that we've defined them in our reports. We're not near those breakout points, but it wouldn't take a lot after the current panic ends if they turn up. Now, I'm going to bet that once T-bonds have had their choking effect, which they're doing again right now, once they've created enough wave effect in the stock market to the downside, asset managers again are going to look at that 60-40 ratio and say, okay, time to move some money out of the stock market and into the bond market. And this time it will work. In 2022, it didn't work. Bonds were down more than the stock market. But right now, it's technically set the other way. So anyway, a lot of drama here. And I think gold knows this is coming. There's no way out of it. It's just a matter of when. And that's why, despite the Fed saying we're going to tighten rates, gold said, I don't care. Okay, we know what you're going to ultimately do. There.
I remember when I just started in the industry, I was on a bond desk at Lehman, bonds and equities, and at the time it was during this time frame after gold had fallen from grace. It was stocks anticipate monetary behavior for 6 months ahead of time, bonds anticipated a year ahead of time, and gold. Back then, gold doesn't anticipate it. And I'm like, why? He goes, well, because it's broken. They broke it, and it'll knee jerk back and forth a couple months later, or when the data comes out. Now, the reason I bring that up is because the bond trader on the desk, he watched gold, even though no one traded it. And I asked him why, and he said, well, he was young, right? So I was young, but he was young. Yeah. He's like, well, gold is money. And it wasn't too long ago that gold was money. And so at the bank, at Lehman Brothers, gold wasn't kept with the commodities. It was kept with bonds. And as a result of that, he always checked with gold before he traded his bonds, just to make sure there wasn't some outlier going on. So now you move forward through the bond vigilantes of the 70s and 80s until they finally got put in their place by, Clinton's behavior. And now, to Michael's point, gold is now predicting, sniffing out as an expression that you hear now. And the reason it's predicting is because gold is money. And I say that from the bond guys, the macro discretionary guys who bought gold in March, those are bond guys. Those are the big guys. Those are the guys who say, I'm not looking 6 months out, and I personally don't want to have all my money in treasuries anymore. So I'm going to throw some money into gold. Gold is a put for them on treasuries. But anyway, gold has gone from inefficient in discounting to actually being more efficient than bonds. Look at the bond versus gold volatility index. Bond volatility is amazingly high. Michael brought up the point about corporate bonds actually holding their own relative to treasuries. That's insane. And in fact, it's being misinterpreted. People will look at corporate bonds, the credit spread between corporate and government, and they'll say it's very narrow. Liquidity is good. Well, they're looking at a broken correlation. No, it's not narrow. People don't want bonds anymore. They're putting their money in corporate bonds instead of treasuries, or they're saying instead of putting $1 million in treasuries, I'll put 200,000 in treasuries, 500,000 in corporates, AAA corporates, and I'll put another $200,000 or $300,000 in gold or tips or something like that. Anyway, I guess what I'm saying is there are indications out there, there are correlations out there that have broken. One, gold now discounts the future again. No doubt about that. I agree with Michael 100%. Two, there's a misconception that treasuries being weak with corporates being strong, relatively speaking, is a good sign. because people are still investing in the economy, and that's another misnomer. That's as bad as saying gold should sell off because the dollar is strong. Those correlations don't work anymore, and I think Michael's point is right about that.
This concludes part 1 of our discussion. Join us tomorrow for part 2, where we'll delve into the potential actions of the Federal Reserve during the next unforeseen panic-inducing crisis. We will also explore the potential risks facing the stock market due to uncertainty surrounding the 2024 US election cycle and the potential for other geopolitical events. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.